New data reveals the stock market meltdown has been canceled. And we are officially in a bull market again. And while I know it's hard to believe for many of you because there's no shortage of bad things that are happening in the markets and the economy, the data doesn't care. And every day, more indicators confirm we are in a strong bull market. So in this video, I'm gonna break down and show you the receipts, the data, the charts. I'm gonna show you what fundamentally changed in March so you can see it clear as day. We're gonna look at other crucial indicators that are confirming what we're seeing. I'm gonna show you the #1 chart that people point to that's certain doom for the financial markets. It has full accuracy, but why it's misunderstood by almost everyone. And I'm gonna tell you what I'm doing and how you need to think about this for your own money and investments. So let's go. All right, if you're new to the channel, my name is Mark Moss. I make these videos to change the way you think about money because you know almost everything you've learned is wrong. If you're just watching random advice on YouTube or social media, talking heads like Jim Cramer or, heaven forbid, what your high school taught you, you're never gonna make it. You have to learn how to see things differently, and that's what we cover each and every week. Knowledge that you can put into action so you can survive this. All right, now real quick, we're gonna talk about data. Let's leave opinions to the side for a minute and let's look at data. Now, first off, a crash. A market crash is coming. That's what everybody says. This is what you want to believe. Fear porn. That's what sells. A crash is coming. And I could tell you dozens and dozens and dozens of reasons why there is a market crash coming. I can certainly argue for it, and I do sometimes. I like to look at both sides of the information. The last thing you want as humans, we suffer from many emotional, mental problems, mental models that cause us problems such as confirmation bias. We think something is going to happen, so we look for information that confirms what our bias is. What we should always do is we should always be looking for information that goes against what our bias. But back to the bias, I can give you a bunch of reasons why there's a market crash coming. The yield curve is inverted. You've heard that. It's nailed a recession every single time with perfect accuracy. The GDP growth is slowing down. We had 2 negative quarters, so we're recession. That's bad. We'll never grow our way out of debt. The credit, the US government's credit just got downgraded. Many other things. Inflation, it's not going away. It's very sticky. The Fed can't really get rid of it. Of course, there's wars, Russia, Ukraine, China. Supply chains are breaking down. There's lots of problems there. The job markets are tight. Consumer debt is skyrocketing. Savings is plummeting. Debt is skyrocketing. It looks really, really bad. Commercial real estate, $2.9 trillion of commercial real estate mortgage-backed bonds that could potentially blow up and crash the whole banking sector. Banks are collapsing. You see headlines probably in your email news box all the time why just those couple banks are just the beginning. It's going to get worse. Treasury's broke now. I could go on. You get the point. The markets are always crashing. As a matter of fact, I've been on Stansberry Radio a handful of times. You've probably seen me over there. They like to get my contrarian take. And I went through their videos here, and I put red or green here. And what you can see is the videos that are about markets crashing, that are doom and gloom, fear porn, they get a lot of views. Any videos that are good, they don't get many views. So for example, key to building a strong portfolio. That'd be good. It got 2,000, only 2,000. But America's in ruins, worst ever economic social times, got 200,000. 2,000 versus 200,000. The next victim teed up in the banking industry, almost 100,000. Declares revolution is only way to escape the Fed, 160,000. But then the next $1 trillion industry, 9,000. You get the point. The videos that are about doom and gloom get a lot of views. The ones that don't do so well. There's always a crash coming, but like I said, they've had me on many times because I have a contrarian take. And as a matter of fact, I hate to say I told you so I won't say it. You can read it for yourself. But let's take a look at this. Here's a video from 9 months ago. It got 300,000 views. And this video says, there is no market crash coming, and here is why. I like to leave opinions on the side. I try to bring you facts, right? The receipts, as I call them. I'm always bringing you a chart, a graph, or a headline. No market crash coming, and here is why. Here, 9 months ago, this is how the Fed is patching the cracks. Again, here we have 9 months ago, 200,000 views, no global financial crisis coming. Again, 6 months ago, new data tells us it's time to buy back into the markets. 6 months ago, 185,000 views. Breaking data shows the Fed pivot is here, do this now. You can see I've been pretty consistent. Now, one thing I want to show you is that even though I've been making these videos with data, trying to leave opinion out with data, I love to show you some of the comments that we get here. I like following you because you think outside the box and use data rather than just hype. Okay, so he's backing up what I say. I'm not trying to hype you up. I'm trying to show you the data, which I'm going to break down a ton of data for you here in a second. Just setting this up here. And this guy right here, I sold out last November and have been patiently waiting for capitulation. That's a bad sign. Waiting for the capitulation that just never seems to come. He's been waiting since November. This would be 9 months ago. So this is 9 months ago. So this is November of 2022. He's been waiting to buy back in. I'm going to show you how bad of a mistake that was. Here we have, I disagree because the Fed has been raising rates since the beginning of the year. So he disagrees that there's no market crash coming because the Fed's been raising rates. And if the Fed raised rates, the markets have to crash, right? Right? He disagrees. It's going to continue to crash until the Fed pivots. Well, the Fed hasn't pivoted and the markets haven't crashed. I'm going to show you that in a second. Let's look at a couple more just so you can understand these are the problems. This is the thinking you don't want to have. Don't you think, though, that the market needs a reset? It can't just keep going up indefinitely. Sure, the market can't go up indefinitely. As a matter of fact, markets crash all the time. Markets are always going to have a correction. Sure. But do you think that the market needs, does it have to crash? Does it have to? Does it have to? Let's break that down. Okay, and then finally, last comment, and then I'm going to show you some data here. And you can see here that this guy's nuts. There's no way we avoid a crash 9 months ago. Well, the big problem with all of this is these guys are thinking emotionally and not data-driven. Actually, this is one of the biggest problems, like I said, we have as investors is that as humans, we're very emotional. Now, real quick, I'm going to run this video with no ads in it because I want to tell you something important. I'm having a special event and I'm going to go live for 3 days and I'm going to show you how you can take all emotion out of your investments, out of your wealth accumulation, your wealth multiplication, and instead use proven systems. You see, 75% of all people that win the lottery are bankrupt within 5 years. Actors, musicians, rappers, they make tens, hundreds of millions of dollars and they go bankrupt. And that's because they don't have systems. So while most people are just trying to get lucky breaks, like winning the lottery, it doesn't work. Instead, you need a plan, you need a system. I'm gonna go live for 3 days and I'm gonna walk you through, as a matter of fact, it's all free to attend. I'm gonna give you tools. I'm gonna give you forms to fill out to help you figure out where you're going, where you're starting from, what the plan is. Like I said, I'll go live for 3 days. I'm gonna answer all your questions. It's free. There's a link down below. Come join me, all right? It's all for free. I'm gonna give it all to you for free because this is what you need. All right, now moving along, let's see how all this has worked in the last 9 months. So here we can see that the S&P 500 is up 30%. So this guy's waiting on the sidelines since November of last year. These guys, no way it can happen. In the meantime, while it can't happen, the S&P 500 is up 30%. It can't happen. Well, it did. And the thing that I want to highlight is that it's super important for us to take the market as it is, not as we think it should be. The market should certainly crash. I mean, it's horrible. I gave you a bunch of reasons why. It should certainly crash. It will certainly crash. It certainly will. I don't know about tomorrow, next month, next year, 10 years. It certainly will at some point. So instead of playing the market as we think it should be, as we think it will be, rather we need to take it as it is, data-driven. That's what I'm showing you. All right, so what changed? All right, there's something that changed. There's a catalyst that changed. I want to show it to you. We can look at the S&P 500 action and we can see the clues in here. So check this out. If we look at the S&P 500, what we can see in this red highlighted box right here is that the market was just ranging, right? Up, down, up, down, up, down in this range. But look at this candle right here and all of a sudden it started marching up. This was in March of 2023. What was it that changed the market from just being range bound? Look at these giant red candles to almost having no red candles and almost all green candles. What was it here? Almost like something happened in March that changed it. Well, let's take a look. Just real quick, you know, I always like to show you the Bitcoin chart. The reason why I like to show you the Bitcoin chart, even if you don't like Bitcoin, is because risk on assets typically smell these moves before anything else. And Bitcoin really is sensitive to this. And we can see that Bitcoin's up 55%. So good job on the S&P, 25%, 28%. Bitcoin's up about 55%. All right, now what could have been that changed it? Well, one, I made a video here. You can see in January, talking about how the CPI basket was changed because the BLS changed the price and the consumer price index changed it. And just this recalculation was going to push CPI down. And I told you be at 3%, which here we are at 3%. But I told you because it was going down to 3%, it would give the Fed the cover they need to start easing the market again. And we have certainly seen that, although we haven't seen the full effects of this. We'll see it later this year. Watch that video if you want the full data on when we'll really see that materialize. But here's what really happened, all right? You probably remember the banking collapse, right? Signature Bank, Silicon Valley Bank, you probably remember that, right? Well, the banks went under, and what happened? Well, the Fed came in to bail out the banks. Most importantly, they bailed out the depositors. And so as the Fed was trying to wind down its balance sheet by tightening the market, raising rates and winding down, tightening the market, as they started to do that, they put the banks out of business. I covered this extensively, a bunch of videos. But as that happened, they had to jump in and reverse course, and they started providing mass liquidity to the market. And that just happened, right in March. Interesting, isn't it? March 10th, I believe, is when this went into place. And you can see what happened. In addition, you can see this backdoor bailout, all right? So right here, March, pretty interesting. They opened up a $100 million back door into funding, into liquidity for the BTFP for the banks, all right? So it was two, one, changing course and adding liquidity back in, and two, a backdoor funding is what fundamentally changed. And what does this mean? Well, we went from a cycle of tightening to now showing that we're back into easing. We're back into a situation where now the Fed has told us, they've shown us that the Fed put is alive and well, and they will do anything to stop problems. So, for example, everyone says that the commercial real estate mortgage, 2.9 trillion, is going to collapse, take out the banks. Really? I'm sure the Fed is just going to take those bonds and put them right on their books. I mean, they've shown us that over and over and over. And this is exactly what's gotten the markets moving. All right, now, we've seen the S&P 500. I showed you a little bit, but let's dig in a little bit deeper because you're probably saying to yourself, well, Mark, that's fine. The S&P has rallied, but it's really just the top 5 or 7 stocks, and they're just driving off of AI, and really the whole rest of the market has not moved, right? Okay, there's something about that. But what we can see is that we have entered a new bull market. Technically, when the market's up by over 20%, we're in a bull market. So we are. However, I want to show you this. So we did see the market, like I said, rally 30%, so well into bull market territory. And here we are 5% from the all-time high of where we were, firmly in bull market territory. What happens here? I mean, it's anybody's guess. Potentially we could drop a little bit, maybe 4,200, and then hit all new highs. That's probably the most likely case. We could just keep going from here. The bulls are strong. They are not weak at this point. But let's take a look back to this question of people saying that, what about the S&P 5 or S&P 7 that's really driving the market? Well, there's something called the market breadth report. All right, this is the advanced decline. So how many stocks in the S&P 500 are going up and how many in the S&P 500 are going down? Now, when we looked at this back in May, we can see there was a massive divergence. There was, most of the stocks were going down, only a few stocks were going up. The 5, the 7, the AI stocks, etc. But look what happened now. This has completely caught up, and here we are tied out. So now the S&P isn't weak with just a couple stocks pulling together. The whole market has pretty much caught up at this point. All right, and it's not just the S&P 500. All right, so that would be one indicator. We want to look at lots of indicators. So what we can see is not just the S&P 500. As a matter of fact, the Dow Jones is breaking out. I put a green line here for the trend line, and you can see right here, it's firmly broken out. So S&P's broken out. The market has all caught up. The Dow Jones is now breaking up. We can look at the breaking out. We can see the Russell 2000 It's sitting right here, trying to break out right here. Hasn't quite broken out, but it's trying to join the party. It doesn't want to get left out. And then what I think is probably a way more important chart, while most amateurs are looking at stocks, where real professionals look is they look at the bond market. They look at the credit markets. And that's what the Fed really cares about more. Not the stocks, but the credit markets. They need the liquidity there. We're in a debt-based monetary system. So you always want to look at the debt. And we like to look at the high yield credit. And you can see right here, it has firmly broken out. And as a matter of fact, it looks like it's not only broken out, but it's now flipped and is using it as support, which is, again, strong bull signals. Now, all of that looks really, really bullish, okay? But what about the yield curve, Mark? The yield curve has predicted every single recession since 1955, and it's inverted. It's not just inverted, it is like the most inverted it's ever been. That means that for certain doom and gloom is coming. Yeah. You're right, it does. It has predicted every recession since 1955. And yes, most likely it will predict that there's another recession coming. As a matter of fact, we can take a look at the chart. Let me show it to you. So you can see, here's the yield curve inversion going back to 1985. So it went inverted here. The black line is inverted. And then there was a recession. It went inverted here, and then there was a recession. Inverted, recession, inverted, recession. So it's been totally accurate. So here we are. You can see how inverted we are right here. As a matter of fact, if we just zoom in on this a little bit, this is going just to 2019. We did have a little dip below it in 2019. And then, of course, we had a recession. But look how far down we are right now. We are massively inverted. So this has to be, for sure, the markets are melting down. Yes, I believe that this will be an accurate indicator. But here's the thing. Here's the thing. It can stay inverted for a long time. You can see back here in 2006, it went inverted, and then it popped back above. It went inverted again. It got more inverted. It stayed inverted. It popped back above, and then we had a market crash. The reason why it's important to understand this is because for a couple of years, it stayed inverted for a couple of years. So it's not the inversion that causes the process or that causes the problem. What we want to watch is when it uninverts. That's the key. So back to these charts, you see that there was a lag. It was when it uninverted is it caused the problem. When it uninverted, it caused the problem. So yes, the yield curve inversion has accurately predicted. Yes, there probably will be another big recession coming, but it doesn't mean it's coming tomorrow. It doesn't mean it's coming next year. It could happen in multiple years like we've seen throughout history. And ultimately what you're looking for is when it disinverts, not the inversion itself. All right, now for all of you doom and gloomers that love this stuff, am I saying that there is no market crash coming? No, there is always a crash coming. There's always a crash coming. As a matter of fact, Allstate accident statistics say that there is a car accident every 6 minutes. There's always a crash coming. But the question is it coming tomorrow, or is it coming next month, or next year, or in 5 years? That's the question. There's always one coming, 100%, which is why the Peter Schiffs and the Harry Dents and the Mike Maloneys will eventually be right. I love Harry Dent. I've read 5 of his books. His data is correct and accurate. The problem is his assumption that he makes that he can accurately predict when the market is going to crash, and time after time after time after again, he gets it wrong. And the reason why is because, again, he's trying to predict the markets as he thinks they should be, without realizing that the Fed has all types of magic tricks up their sleeve, and instead we should be taking the market as it is from a data-driven approach. So, yes, there's a crash coming, but we have unemployment looks pretty strong. The experts are predicting about a 50-50% of recession. It's about 58% they're saying in recession. So about 50-50. But like I said, it's important that it's not as we think it is, but rather it is. Now, back to there always being a crash, we can look at this. 100 years of Dow Jones data. Crash, 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 crash. There's always a crash. We can look at the NASDAQ. Same thing. Crash, 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 crash. We can look at the S&P. Crash, 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 crash. You get the point. So yes, there's a crash coming, but when? It doesn't mean it's certain. And like I showed you from the yield curve control, it can stay inverted for a long time. So the bull market, right? Yes, we are officially in a bull market, but a couple words of wisdom here. Bull markets are extremely volatile. So doesn't mean, remember, nothing goes up in a straight line. Bull markets go like this. So don't get faked out on these dips. Understand that the trend is your friend. You've probably heard that. Also, the S&P, as I kind of showed you on the S&P chart, it looks like if you're looking at technical analysis, which I don't put a whole lot into that, it looks like we could probably sell off to 4,200-ish and then run higher, but the bulls are strong. We could keep going, so there could be a dip. Now, in bull markets, it's important to understand what type of market you're in, a bear or a bull. In bull markets, you buy dips. In bear markets, you sell rips. So when a bear market is going down, when it bounces, you sell. In a bull market going up, when it dips, you buy. So it's important to understand that. Now, this could all change, right? This could all change. A massive recession could come and destroy all of this. But however, we saw in 2020 that the economy, a recession affecting the economy, we saw that the economy is completely different than the markets. The economy was literally shut down. Businesses were literally put out of business, and yet the markets went to new all-time highs. So yes, a recession could potentially come. It will come. 100% guaranteed it will come. We don't know when, but does that mean that it crashes the markets? Well, 2020 shows it doesn't. So all of these things could change, but the key takeaway is take the markets as they are. Look at the data and participate in the markets as they are. For now, we're going up. If this data changes and we go back down, guess what? I'll sell my positions, I'll go short, and I'll make money on the way back down. And then I'll make money on the way back up. So you want to be nimble, you want to be actively managing your portfolio, not day trading, but you want to be paying attention. Now, like I said before, I am running this with no commercials. Hopefully you enjoyed that, so I can tell you this important thing. Next week, I am running a live 3-day event. I'm going to go live for 3 days, and I'm going to give you some of my tools, some trackers, some spreadsheets, some questionnaires to help you take all the emotion out and figure out where you're going and become what I like to say financially sovereign. Make enough money where you don't have to worry about what's happening on in the world. The world's scary, the world's dark, but it doesn't have to affect you if you can take your emotions out and you can build systems to automatically scale your wealth. We're calling it the science of scaling your wealth. The science of scaling your wealth. 3 days, I'm gonna go for live for free, all for free. There's a link down below. I'm gonna give you all the tools for free because that's how much I care about you. So check it out, there's a link down below. As always, let me know what you think about this video, and are you going to take a data-driven approach, or are you letting emotions run wild with you? Let me know in the comments down below. Give me a thumbs up if you like it. If you don't, give me a thumbs down, that's okay. But either way, leave me a comment, let me know. Also, please share this video with somebody who you think needs this, right? I'm sure you have some friends who think that this all doom and gloom. Share this video with them, help them get a different perspective. That would be greatly appreciated. Like it, share it, subscribe if you're not already. That's what I got. To your success. I'm out.